responding to White House Office of Science and Tech Support. Please welcome to the stage, host of Coin Stories and Hard Money Show, Natalie Brunell, partner at Castle Island Ventures, Nick Carter.
Hi, everybody. This has been such a fantastic event, and I'm really honored to be here with Nick Carter, who is a fantastic researcher and analyst in the space. He's a general partner at Castle Island Ventures. And we're going to talk a little bit about Bitcoin mining, which has been a topic covered extensively here at the summit, but also about this FTX collapse, because I think it raises some really big questions and concerns, especially when it comes to intervention by regulators. So, Nick, thanks so much for joining me. And I want to start out with sort of this bear market update when it comes to Bitcoin mining. It was sort of covered in the previous panels, but what's your take on the current state of Bitcoin mining economics, given the fact that we have soaring energy costs, we have high hash rate, and we have an increased cost of borrowing? So what's your take on all of this?
Yeah, thanks, Natalie. I was here last year, actually, and thanks for the invite again. Incredible conference, and the mood about mining was very different, unsurprisingly. It's probably the most challenged sector in the whole crypto space right now, which is tough to see, but I'm optimistic. Obviously, a number of well-run mining businesses, and we just heard from some on the prior panel, will survive and make it through. But the set of conditions that have arisen around the mining space are some of the most challenging I can imagine. So the commodity you're mining, Bitcoin, is down 70%. Energy costs are up across the board. And unfortunately, a lot of miners did not lock in sort of fixed rate contracts, fixed rate long-term contracts that are more on variable contracts. So they're exposed to rising energy costs. Then against that, you also have hash rate spiking. And hash rate, it's not even Bitcoin's fault necessarily. The Ethereum merge also affected Bitcoin miners because a lot of these Ethereum miners then converted their data centers to Bitcoin. They acquired ASICs after Ethereum deprecated mining and moved to proof of stake. And so if you look at the chart of hash rate, there's a spike up right after the merge occurred as those miners went over to Bitcoin. So that doesn't help. Of course, hash rate has been climbing everywhere as people ordered a bunch of miners 12 months ago that they're just turning online now. Then, the last thing that's challenging these miners is interest rate spiking, which raises the cost of borrowing. A lot of the public miners were engaged in very aggressive borrowing, had stacked on a bunch of leverage. So it's those four things all at once. It's a quadruple whammy. And we've seen that has been sufficient to wipe out literally some of the largest publicly traded miners. Core Scientific, for instance, probably headed for bankruptcy, unfortunately. So the public miners themselves, they face these perverse incentives where their incentive was to stack on as much hash rate under management as possible at the expense of more expensive PPAs and using larger and larger amounts of leverage. So the washout there is going to be significant. And there's maybe 25 public miners out there today. I think that'll be consolidating down to fewer than 10 in 12 months or so. So, just a shocking consolidation, a classic commodity cycle.
Well, it's interesting because a lot of people are focused on the FTX collapse and the downward pressure on Bitcoin's price because of the contagion in that space. But really, with these expected bankruptcies, if there's a consolidation, doesn't that pose concerns for increased centralization?
Yeah, increased centralization. Also, you could say the spot price of Bitcoin, too. A lot of these miners have already sold off that Bitcoin on their balance sheet as they struggled to remain solvent and service their interest payments and obligations. So I would argue from the Bitcoin perspective, a lot of it has been experienced, that's been incorporated into the price. But yes, this is something that people aren't talking about as much is there will be fewer miners. There will be more consolidation. And it was a fairly well-dispersed sector. The U.S. share of mining is probably around 40%. And there was no one miner that was maybe more than 5% of global hash rate. During a period of consolidation like this, the well-capitalized miners with the deeper balance sheets will acquire their failed competitors. And we will see consolidation down to a small number. And so that's not strictly the best thing for the decentralization we want to see in proof of work. Obviously, I think it's still far superior to proof of stake, for instance. But yeah, it's actually trending in the wrong direction from a decentralization standpoint.
Well, let's talk a little bit about Bitcoin mining and energy use because you wrote this very extensive commentary responding to the White House climate report or the report rather on the energy use of Bitcoin mining. And for those of you who haven't read it, and you should, can you provide a couple of takeaways? And since then, have you heard back? What is the state of the White House when it comes to Bitcoin mining and their take on energy use?
Yeah, so just for context, the White House, Biden had a series of executive orders where he asked for all these reports, I think there were actually dozens, about various topics in the crypto space, and one of them was on crypto mining. And it kind of shows their level of diligence. It looked like they threw this report together on a last-minute basis, like it was a college assignment. They turned it in a couple hours before the deadline. It was very hostile to the crypto mining space, unfortunately. And they even talked about nationwide level legislation to effectively undermine Bitcoin mining. And so it was extremely disheartening to see. But the report itself was not particularly well researched. It wasn't academic really in quality, and it cited a lot of critics, and it didn't really cite the industry at all. There are a few things they pointed out. The main thrust of the White House report was that they are holding Bitcoin mining to an extremely high standard with regards to the energy inputs that they're using. A standard I haven't seen any other industry held to. And I think it reflects the fact that they think that Bitcoin miners don't have a legitimate claim on society's resources, right? And so they're insisting that not only do Bitcoin miners use renewables, but also that they don't compete with any household use of energy. And even if Bitcoin miners are using renewables, they feel that it's still somewhat illegitimate that they are using up a scarce amount of renewables that would be otherwise put to other industrial uses. And so it's almost like it's not enough in the eyes of the White House for Bitcoin miners to actually rely on sustainable sources of energy, as we see happens here in Texas, right? Abundant amounts of wind and solar, in particular in West Texas, right? You see a huge number of miners, identifying those stranded renewables and using them. In the eyes of the White House, that's not even sufficient. The other thing is they totally, or for the most part, dismiss the effect of flared gas mining, right? So mining with stranded methane, right? They effectively say that even though that does improve the emissions profile of the oil and gas sector by capturing this methane and combusting it in a more complete and safe way, they kind of dismiss it by saying, well, as part of the green energy transition, we expect that all oil and gas extraction will be deprecated, right? And so because that's their underlying premise, they're kind of dismissing the incremental benefits of Bitcoin mining using otherwise flared gas. So it was really disappointing. And unfortunately, they didn't really engage with the grid stabilization arguments that we've heard today that Bitcoin miners have been making persuasively. They didn't really engage with some of the good work around additive renewable usage that Bitcoin miners are doing, bringing to bear more renewables. They pretty much wrote off the industry's contributions, and it was a super hostile report.
So you're not going to be meeting at the White House anytime soon?
They actually invited me to give a presentation about a year ago, and they failed to take any of that into account. So they're really not engaging productively with the industry.
Yeah, it was really surprising for me to see that they were quoting a Dutch central banker who has a blog and things that were not peer-reviewed. So there's a lot of work to be done. But I wanted to ask you, because there's data, there's statistics out there that claim that, at least in the U.S., 60 to 70%, or possibly even more, of Bitcoin mining comes from sustainable energy sources, renewable energy. How accurate is that, and who's keeping track of this kind of information?
Honestly, we have to be realistic about that, and I think those estimates are overestimates. My allegiance is really to the truth, right? And even though it is the case that there are a bunch of miners that are attacking and using renewable sources, the industry estimates so far have been weak, I would say. And it's not good enough to go on a state-by-state level and say, well, this is the average energy mix of a given state, so we're just going to assume that miners follow that mix. You need to do a bottom-up analysis. You need to go to each specific mining installation and do an accounting, whether they're behind the meter using a local proprietary generation asset or whether they're drawing from the grid. You need to do that bottom-up accounting before we can make these defensible claims around what the energy mix in the aggregate of Bitcoin is. So far, no one has done that work. Now, I've met a number of individuals and entrepreneurs that are actually trying to put together these data sets, but the truth is we don't currently know what the energy mix of Bitcoin mining is. There is a lack of data. There's been a failure of academic institutions to do this. The industry has not yet come together to produce that data set. And in the absence of that data, it gets filled with these hostile takes that come from people like De Vries, who works for the Dutch Central Bank, that instead produces erroneous estimates of Bitcoin's emissions profile. So the burden is really on the Bitcoin mining community to produce this data and to be more transparent about what their energy mix is. Until we do that, the narrative will be dominated by critics.
Well, let's go back to first principles and some fundamentals here, because one of the big sort of PR statements that I hear a lot lately from the Bitcoin community is Bitcoin is driving investment in renewable energy. It can improve energy economics for wind and solar. Can you kind of break that down, especially for people that don't have a solid background in energy use or the different energy sources that are out there? How is Bitcoin actually helping, and what are some challenges? Because I think in the spirit of your truth statement, we have to be realistic that we're not completely there yet to be able to just leapfrog and get rid of fossil fuels.
Yeah, and it does become challenging because it's not just a matter of understanding Bitcoin mining, but also understanding power dynamics, which, few people have that intersection. We rely on those experts to surface it. The Texas example is fantastic, though, because Texas, or the ERCOT grid, I think, has the highest wind penetration of any, specific ISO in the U.S. So for an example, out in West Texas, there's abundant wind and solar resources. And unfortunately, because those are intermittent sources, they're not producing energy in the same profile that the grid demands it, right? Because you always have to match the demand and the supply, and we don't currently have a ton of batteries that can soak it up. And so you end up with negatively priced power or zero priced power for a lot of those hours in the year. And so Bitcoin miners come in, they're that buyer of first resort, because Bitcoin is this location agnostic tool where it doesn't matter where the Bitcoin's mined. And that's very different from other industrial or commercial buyers of energy, where they have to consume that energy in specific places, right? In population centers. Bitcoin miners can go out to the middle of nowhere and mine freely. So they can go after these stranded sources of power, bidding up the floor when there are no other bidders. Right? And so that fundamentally improves the return profile of building new generation assets, in particular renewables, that may not have other buyers. One interesting new development is the the falsely named Inflation Reduction Act includes enormous subsidies for wind and solar, adding on to this same exact problem. Every year in the U.S., we see more and more negatively priced power. That's because wind and solar comes on. It's not fully transmitted. There's not enough high voltage transmission to demand centers. And so you end up with more and more negative pricing, which is a market signal that there's an imbalance, right? And so Bitcoin miners are coming in and soaking that up. Now, they're not exclusively mining with wind and solar because, of course, they don't produce all the time. So the newer model that we see from Bitcoin miners involves what's called grid firming, whereby they pull from the grid some percentage of the time, and then maybe they're behind the meter with a wind or solar installation the rest of the time. So it's kind of a hybrid model, but on balance, that improves the return profile of these renewables. And it's something that you could see where Bitcoin miners would be the first consumers, the first buyers of energy for new developments as we wait for interconnection, as we wait for transmission to be built out. So I would say that is a fundamental improvement. And then on the other side, when there's a grid scarcity event, as has been well documented, and there was an excellent panel on this yesterday, Bitcoin miners have these break-even points, right, where at power prices exceeding their break-evens, they're simply turning off. And in some cases, they're enrolling in these formal programs like demand response, where they're compensated for this, right, because they're effectively providing insurance to the grid. They're allowing the power to flow to households and businesses that need it during scarcity events. So in terms of the sort of energy price chart, they're bidding up the negative or zero price power, and then when there's a scarcity event and power is very expensive, they're typically not consuming. So both on the undersupply and the oversupply side, they're sort of ameliorating the prospects for the grid. So I would say, on balance, a very good phenomenon. And I really more broadly question the narrative that we see from the White House that a new buyer of energy is a bad thing, right? Bitcoin is a very benign buyer of energy. It buys energy that others won't buy. And so from my perspective, if we're going to pursue a green transition and electrification of everything, trying to deprecate fossil fuels and a massive growth in wind and solar, we need these kinds of buyers. If we are going to re-onshore our industrial capacity and bring it back into America's heartland, we need to electrify things. We need a significant growth in generation and transmission. Miners are the ones doing this. They are supporting that transition. And so I don't see how you could possibly characterize that as a bad thing.
What's it going to take to mine more with nuclear?
Well, there are miners that are using nuclear. TeraWulf would be one example. They have a facility in Pennsylvania behind the meter. So nuclear, of course, produces very stable energy. Of course, the grid doesn't have a stable demand, so it does actually pair very well with nuclear. The problem is that this country is not adept at building nuclear because there's so many regulatory barriers there. So there's not necessarily enough new nuclear supply coming online such that Bitcoin miners are signing agreements with nuclear operators. That fundamentally has to change before we see this interplay between nuclear and Bitcoin mining. Of course, it does pair very well, but there's enormous regulatory barriers to nuclear, unfortunately.
And before we move to the FTX story, I just want to ask you, because I know you were talking earlier with some folks here just about regulation from state to federal, some of the differences and the challenges, some states, putting forth moratoriums on Bitcoin mining. What are you concerned about there?
Yeah, so New York State passed a bill, which is currently sitting on Kathy Hochul's desk right now, basically banning a specific type of Bitcoin mining in New York, effectively any mining that occurs behind the meter with a specific power asset that's thermal in nature, that would be banned. I expect her to sign that bill, right? New York has a fair amount of Bitcoin mining, and that will be a loss, and that will be a shame that they're driving out, a novel industry like that from the state. But that's the kind of misdirected thinking they have up there, unfortunately. Texas has been far more favorable to Bitcoin mining, and it'll be the heartland of Bitcoin mining for the foreseeable future. This is a state with abundant energy resources and a favorable regulatory climate and a healthy respect for property rights. So I do ultimately expect the Biden administration will continue to kvetch about Bitcoin mining, and I do see it as a states' rights issue. It is your right to determine your energy future and whether your industrial sector will be fed with abundant power or not. So it's fundamentally a state versus federal issue, and I think we'll continue to see a tug of war there, and it'll come down to places like Texas to really enshrine the future of Bitcoin mining in the U.S.
Yeah, it's really inspiring what we're seeing here. All right, I know this is on everybody's mind. It seems like there's a new headline breaking every single minute. So first, why don't you give us your reaction to everything that happened with the FTX collapse and the news since? We haven't had an arrest yet, which is really surprising for some people. They filed for bankruptcy, 1 million creditors, potentially 0 Bitcoin. I mean, how did we get here?
Yeah, it's absolutely shocking. FTX was the 3rd or 4th largest exchange globally, the international business, and apparently misdirected and siphoned out $5 to $10 billion of depositor capital. So an immense fraud, and it's going to set back the industry seriously for years. I do think it'll be somewhat akin to the 1930s, where you see a collapse, in that case in the securities market, and then new regulation gets brought to bear. And it's kind of up to us as the industry to ensure that the resulting regulation from this failure is common sense and actually supports consumers, right? Supports consumer protection and allows the industry to thrive while not being overly punitive. There's a risk that if Bitcoiners don't have a seat at the table as states and Congress now pursue regulatory attacks or developments on the industry, there's a risk that we get left behind and that it just becomes a way for the government to attack the crypto space. So we can't let that happen. We need to be proactive in terms of laying out an agenda for how exchanges should operate, how they can protect consumers while still allowing them, providing these vital services, which we do have a revealed preferences to use exchanges. I mean, they provide fiat on-ramping. They provide third-party custody. Of course, holding your coins on your own is always better, but there's a certain sector of society that will always prefer to use exchanges. So the question is now, how do we reform exchanges such that they behave better and they protect their end users?
Well, let's talk a little bit more about that, because now it seems like there's this very big feeling of I don't know if I trust my exchange. Everyone's pulling their coins off to cold storage. It's great that everyone's learning about self-custody, but you mentioned exchanges are the on and off ramps for this industry. So what about proof of reserves? Because I know there are some Bitcoiners that are skeptical of it. You are a big proponent of proof of reserves. So how exactly do they work, and what do you see going forward?
Yeah, I think this is one of those vital pieces of the toolkit. It's not individually sufficient in terms of reforming the exchange space. There's other components that need to be added, like not mingling client and operating capital and maintaining the seniority of depositors in a case of liquidation. So those are kind of legal structuring things that need to be done. Proof of reserves is a crypto native solution to the lack of trust in exchanges. Basically, what it refers to is a procedure whereby exchanges do a cryptographic proof of assets held, which is trivial, and then they also attest to the liabilities outstanding. So they effectively allow depositors in the exchange to prove that they're included in the liability set. So you can double check, and then you basically verify that the liabilities add up to the assets. And this is a procedure that's existed for around 8 years. Exchanges have been doing it periodically, not as many as I would like. After Mt. Gox in 2014, there was a wave of enthusiasm, and now we're seeing the second big wave of enthusiasm for proofs of reserve. Of course, holding your coins is better, but this is one way to ameliorate the third-party custody situation, and it's happening in a bottom-up way right now with no one mandating it. I think mandates might be reasonable in this case because the exchanges have shown that they can't be trusted, but at a minimum, I'm very encouraged to see there are now a couple dozen exchanges that are looking to do proof of reserve, and it is kind of a bottom-up, crypto-native way to do it, so I'm really hoping it happens.
It's really interesting. I mean, I've been talking to people that hold their Bitcoin or purchase their Bitcoin on different platforms. Everybody's been getting an email this week, your funds are safe, or here's what we're doing. I think Coinbase put out an ad in a paper somewhere that said, you can trust us, but you shouldn't have to, something like that. So it's interesting, everybody has this question. And I think something everyone's monitoring as well is, who's next? There seems to be a contagion in crypto. What are you looking at when it comes to what the next domino could be? And obviously that would mean the price could potentially fall further.
Well, I think the onshore exchanges, the Coinbases and the Krakens and the Gemini of the world, I think they are credible institutions and they are regulated in a way, although not federally regulated. It tends to be state by state. And so, a lot of people are concerned about them. Where I would focus in terms of the next steps and the contagion would be the offshore exchanges, right? There's a reason FTX was based offshore. It's because they had no meaningful regulation. And there is a whole cohort of these offshore exchanges. Even Sam Bankman-Fried, FTX CEO, claimed that there were secretly insolvent exchanges. And I think one way to test that is simply to withdraw your coins, right? And that is happening right now. These exchanges will be tested with their liquidity. And I do expect there'll be further failures there. I would also look at some of the lenders. Lenders are now extremely challenged. Many of them gave loans to miners. So, of course, that sector is affecting them. And then Alameda itself was a huge borrower. And so we will continue to see this ongoing contagion in the lending space, which is really just a continuation of what we saw over the summer. So I don't think it's over. The worst may well be behind us, but we'll continue to see some failures in the crypto market.
It makes me think of what Greg Foss recently said on my show. Risk happens fast, and the contagion can spread very quickly. All right, I don't know if you guys saw, but Elizabeth Holmes just got 11 years for defrauding investors of $1 billion. How much time do you think SBF will get?
I think it deserves 8 times that.
All right, thanks so much, Nick Carter, everybody.
Thank you.
I'm Lee Bratcher, the president of the Texas Blockchain Council. Thank you to everyone who came out to this year's summit, helping us make it the best one yet. Now more than ever, we need professional industry associations like the TBC to help craft effective policy instead of the CEOs of centralized exchanges roaming the halls of various state capitals or in DC. Texas is quickly becoming the center of the universe for Bitcoin, blockchain, and digital assets. If you want to be part of the future that we are crafting here in Texas, join the TBC today.